All right, we'll wait a minute or so just as people start trickling in. Yes, look, this will be an exciting event. Just look at the attendance, how quickly it's moving up. So it looks like there's a lot of interest here. Okay. Welcome everybody to today's Distressed Commercial Real Estate webinar. On behalf of the Riverside Experience, we thank you for taking the time to join this webinar. We have a great discussion on tap featuring some of the industry's top experts. This event is brought to you by the Riverside Experience and the Riverside family of companies. Riverside's motto is that we are more than just a title company. We are your partner in helping you get your deals done. Whether it's our top-rated title services, 1031 exchanges, cost segregation, or entity formations, Riverside is there for you. My name is Mark Feld, and I run the Riverside Experience. This is a platform that provides comprehensive real estate financial modeling training. We offer interactive educational events and webinars, and third-party financial modeling and OM creations. And now we're going to turn the program over to our panelists, led by Shlomo Chop. So Shlomo, please take it away.
Thank you so much, Mark. Good morning, everybody. Thank you so much for joining us on this webinar, Distressed Commercial Real Estate. And I think the subline is extremely important, which is navigating divergent interest for optimal outcomes. As you'll see in this conversation, we'll talk about the life cycle of distress from the start to its finish. And that's why we have this great team over here. Starting the process when you have the lawyer, Drew Demers, who represents that side of the equation, Stacy Stack-Rudolph, who is involved on the due diligence side of it, on many different aspects of the process. And ultimately, from my side, I deal with borrowers as challenges arise. And then Brad Carver could talk about the disposition side of things and what lenders look for. So thank you so much. And we'll talk about these divergent interests and sort of how to get around these divergent interests to the best possible. It's never obviously perfect. With that, I'm going to have everyone introduce themselves very quickly and sort of tell us also what it is that you're seeing very quickly, just as a general overview that you'd like to touch on over here, and also how we can contact you if it comes to that. Just put that out there, and we'll go that over time, because it's important that if one of you attending hears something that you like, that you know how to reach out and communicate as needed. That could be social media otherwise. So with that, I'll just go at least the process of the deal. So I'll start with Stacy. I'll talk a little bit about who you are, your background, and what parts of the deal you get involved in, what you're seeing, and generally how someone could reach you.
Thanks, Shlomo, and thanks for inviting me to the panel. Stack Solutions was formed about 7 years ago when I stepped out of distressed debt as a lender. I've been in the business for about 25 plus years and have played everything from the servicer to the special servicer to the BP buyer to the lender on most aspects. We do advise equity owners as well. Basically, we're a small concierge firm that provides everything from underwriting to asset management, basically catering to what the client needs. What we've seen most recently and what we've been playing in most recently is asset management and bridge debt origination. As you guys know, it's been volatile with what the Fed has been doing, what the economy's been doing. And so lenders are trying to get their arms around where are cap rates going, where are rates going, where are values going, so that they know, where, when they're lending that money, how that term is going to perform and how the exit's going to happen. So that's where we're seeing the most challenges right now.
Got it. And Stacy, if someone wants to reach out to you, can you just briefly give us your website?
Sure. I'm www.stacksolutions.com. You can also reach me at sstack@stacksolutions.com.
Got it. So Stacy, you're involved in the beginning underwriting, and then you also advise as we move forward in the process, as lenders need additional diligence, you're involved, and you were very instrumental in the setup of multiple and setup of and running of the surveillance side of shops, including on the distress side. Just wanted to make sure that everyone knows that about you. Drew, good morning. Please tell us very quickly about your background and sort of what your day-to-day is and what you're seeing in the market, please.
Sure. Good morning, everyone. Thanks for joining today. And Shlomo, again, thanks for having me on the panel. I appreciate the fact that we're in a very strange economy right now. So I've been doing this now for 20 plus years on the commercial real estate side. My background is as a commercial litigator with the large law firms. And my current firm, Weiss Road, is a little smaller. We have about 100 lawyers based in South Florida. My experience has been traditionally on the bank side of this equation, and only recently in the last 3 or 4 years have I moved more towards the borrower side. It's an interesting and very different perspective working out loans for borrowers. And the reason for that is on the bank side, you sit and wait for a default or wait for an issue to arise. You have your set of loan documents that you drafted, and you have all the rights and remedies in there and all the checks and balances that you're the police over. On the borrower side, what I see traditionally, and I think where the value is for Shlomo and Stacy, is borrowers typically come to me very late in the game. There's already been a default letter. There's already been a host of issues that probably should have been addressed a little earlier. And so it's a shameless plug for our consultants on the panel, but it is critically important for workouts and distressed issues to be dealt with as soon as they arise. And when I say that, what I'm seeing now is borrowers come into the equation, without their financials organized, without a real game plan for how they're going to work things out. It's a little different today than it was 10 years ago during the Great Recession, because values have changed. We talked about that a little bit before the call, and we'll talk about it during this call. I think it's important, though, to realize that there's a comprehensive approach to this, and getting your arms around these issues early will stave off big problems later. And big problems is where I typically come in.
Thank you so much, Drew. I appreciate it. And your website is weissserota.com. Is that correct?
Sure. Our website is www.wsh-law.com. And I can be reached by email at a.demers, my first initial last name, a.demers@wsh-law.com.
Perfect. Thank you. Brad, good morning. Thank you so much for joining us. You are probably going to get a lot of questions given what you do. And guys, there's a question, the Q&A area, so feel free to throw questions down. We'll get to it as soon as we can. So Brad, if you could please give a brief introduction, talk to us about your background, what 10X does if everyone's been living under a rock, and sort of what you're seeing in the market and what we should be preparing for. Thank you.
Thank you. Good morning, everybody. I'm Bradley Carver. I'm based here in Miami, Florida. I'm with 10X Commercial, which is the nation's largest online commercial real estate and transaction platform. We've sold over 10,000 or have had over 10,000 transactions in excess of 29 billion through the last decade. We were formerly auction.com and then rebranded the commercial division to 10X Commercial and recently acquired by CoStar Group about 2 years ago. So with us, we're a disposition platform. It's a marketplace to bring buyers and sellers together. And when I say sellers, anyone from the private client side, institutional groups, lenders, servicers. So 2 buckets, distressed and non-distressed. So it's a way to bring it to market in a quicker, more efficient manner, typically about 100 days from start to finish, cast a wider net through our global omni-channel marketing approach, and then have a high certainty of close with our as-is, whereas non-contingent contracts. In regards to the process, there's a lot of different avenues that we can take, whether we're working directly with the lenders or the servicers, or getting ahead of it and kind of partnering with the borrowers and the lenders prior to them taking it back. But it's an alternative disposition strategy to kind of position this as we navigate through this uncertain market. And we've been growing like crazy. I think the acquisition of 10X by CoStar Group has really helped broaden our marketing reach and kind of put 10X a little bit more on the map. So statistics are showing that more and more people are showing up and kind of bringing people together. And that is the goal. And if anybody has questions, they can go to 10-x.com and look at the different listings out there to learn more information. And they can reach me at bcarver@10-x.com, ten-x.com.
Thank you, Brad. Brief introduction for myself, and we'll dig in. My name is Shlomo Chop. I'm the managing partner with CPS. I'm a distressed debt advisory firm. What that means is, and this will lead directly into some of the first things we're talking about. Many borrowers, not going to say most, it's very generalizing. Many borrowers do not understand what their loan docs say. Quite frankly, unfortunately, as many attorneys on this call know, some attorneys that have drafted had no right drafting it, or no right commenting on it. And it puts them in position to be left in a, puts them to be left in a negative position. And even borrowers that do understand the loan docs, especially those, do reach out to me when they see an issue down the road, coming down the road, and I guide them through the entire process. That means not only understanding mitigating issues day one, but also dealing with a lender to try to resolve the business plan. And even if you're giving back the keys, which is no such thing as you just get to give back the keys, this thing of jingle mail, the postage pay there's no real postage for jingle mail, just so you know, it's impossible. You don't just, there's no option to sell your property to your lender. Just guiding through that process so that it's done in the best possible way without there being exposure. So that's what I do. I deal with borrowers on an ongoing basis. My website is caseps.com. You can get me on almost all social media at Shlomo Chop. And you could email me SCHOPP as in Peter at caseps.com. So with that aside, what I'd like to talk about to start, what we'd like to talk about is preparing and dealing with distressed commercial real estate. But the preparation for distressed commercial real estate, Stacy, doesn't that start day one when you get a term sheet? They say money is good. It doesn't solve problems, just gets you there in style, right?
Basically, you need to know what you're signing up for day one, and whether that you need to understand if the cash management, if you're getting into situations with different triggers, such as cash management, ways that the lender can sweep the cash or shift control. Because me as a lender, that's what I'm looking for. How can I make sure that I have as much control as possible, especially in the tender scenarios where there could be problems or could be shifts, whether that's lease expirations, just rotations of quarters and financials, just tax time, tax adjustments, whatever it is. I'm looking to maintain as much control as I can as a lender. So I'm going to put it into all the places, all the different contemplations that I can. So you need to understand your docs from the top to the bottom, every period, every comma.
So just to elaborate just a bit more on that and shift over to Drew to give a comment on that. So when you get a term sheet from an originator, right? You send him information, reviews it. It takes a couple of days to get you a term sheet. Why? I mean, he's getting you a great number. How did he get you that great number? What happened is he sent it to someone internally and they created a model. How can we make sure that the cash flow that we're going to sell to another third party, which usually is what you're going to have, unless you're dealing with regular savings and loans, that's assured? And if you're not watching what you're doing, you'll get essentially, well, if you have 3/4 of DSCR above X, and the model clearly shows you'll never have that, or you'll have 3/4 of DSCR above X and this tenant's in place, etc. So Drew, very often I've seen borrowers saying, okay, term sheet, let's just deal with my mortgage broker, get it done, okay? How important is it to negotiate? Well, obviously it's important the way I'm talking, but tell me, give me some flip sides of it to actually understand what you're signing and negotiate legalese. What happens once you sign that term sheet? What happens next? And what if you didn't actually negotiate it as a legal document?
Sure. Well, a couple things. So let's think about first how these loans get originated and how borrowers shop for loans. So typically you'll go to a commercial loan broker and you say, I want the best deal, right? This is my asset. This is what I'm willing to do. And that's how you shop. people shop based on price. They don't really shop based on fine print. So by the time you get to a term sheet, you're pretty happy with your rate, but there's terms in the term sheet. I've drafted many a term sheet. They're typically 2, 3, 4, maybe 5 pages. And the big caveat at the end of the term sheet usually is subject to additional terms that the lender may put in at its discretion. So we all know that the lender, and I represent a number of lenders, the lender will put in the terms that are its standard terms approved internally by loan committee. And at the end of the day, by the time you get to signing, by the time the borrower gets to producing all of its financials, we've got the appraisal, we've got, all of the stuff that goes into a big commercial loan. By the time you get to the closing table, it's too late. You've already kind of sat down and you're starting to sign documents that you may not fully understand. Almost always, borrower has counsel in these deals. And most of the time when you're on the lender side, my favorite line is, as a lender's drafting attorney, is these are the lender standard terms. We really can't deviate from them very much. We're happy to take your red line comments. However, the lender is only going to bend so much on these terms. And so, think about in the context, and Shlomo, you and I just had one, the loan agreement was 115 pages. The mortgage was like 45 pages. And at the end of the day, there's a sea of terms, conditions, covenants, restrictions, and warranties in these documents. And so it's critically important to understand all the different ways, as Stacy mentioned, that you can kind of get tripped up in here in the commercial loan realm. There is a way to negotiate, obviously, but think about your motivation coming in as a borrower. You're coming in based on price. You're not coming in really thinking, how is my debt service coverage ratio going to be affected next year if one of my tenants leave? And so you have to have a little foresight to understand, all the different covenants, conditions, deadlines that are involved with these large loans.
Yes, and I think it's fair to say, and Stacy and Drew, tell me if you disagree. The second you sign that term sheet, your leverage falls away because you're no longer dealing with the salesman.
100%. Since we're on the credit, underwriting side a lot of times with the lenders, and we're trying. I think it's really important to understand that the lender has these standard terms depending on where they're going to put that debt, whether they're going to hold it on their balance sheet, sell it into a securitization, which we'll talk about later. And they've crafted those to try to make the path more streamlined. But as you said, Shlomo, when the person you're dealing with on the front side is the originator, he's the sales guy. He's the one that's going to make his commission. Then the credit people have to try to execute that deal, because we do want to put money out as far as a bank. We do want to lend. But then you're tripped up with, goodness gracious, nobody thought about the fact that, in this state, the taxes can get switched upon a sale. And now you're talking about something that's tripled, and that's going to affect your return as well as the bank's debt yield. So back to you guys.
Yeah. And I think at the end of the day, the last, banks need to put out money. That's how they make money. Right. And they'll solve for what's at hand. And if what's at hand is a term sheet you negotiated, they'll try to solve for it so they don't retrade you if they sign it, right? Or at least you'll figure out early on enough so you're not down the path. Obviously, if you're sitting there, they're about to give you a massive amount of money, you're about to cash out $30 million. That's all great. You just got to make the calculation whether it makes sense for you to cash out or not. Brad, I think this is an interesting point for you to jump in with regards to how buyers and sellers work, because I think if there's one thing, I actually believe that you and your role are essentially a deal-making psychologist, right? You understand what gets buyers to buy and what gets sellers to sell, and how to go and move things around to make things work. So how do you think, just talking to people where they put down a hard deposit in 10X, because that's the beauty of selling on 10X, right? Your product will trade if you give it the ability to trade, right? If you buy into it, right? So how do you see the psyche of a buyer and seller? Do how you're able to get them to, in a way, and this is, maybe for buyers not the best thing to say, but to compromise where they were otherwise going to go on a deal, right? So if I'm dealing with my lender, how do you see that playing out? Do you deal often where people are so desperate to get the deal done and do a bad hard money deal that's recourse or so?
Yeah, so all good questions. I'll try to be short-winded with my answer, but in short, I mentioned 10X is an online marketing and transaction platform. And so our job and our real role is to bring a market to the table. At our roots, CoStar 10X, we're a data company. So we have data on buyers, information with a database that we push this out to in collaboration with the broker. So on our marketing efforts, you're getting the best of both. Through the marketing efforts from the broker, because every deal requires a broker, and then the 10X marketing efforts as well. But through the process, our goal is to bring a market to the table, because the market does not know what that strike price is, that reserve price is. And so during that process, the intent is to get feedback, understand what the market is saying that they like, what they dislike, where they're pricing it at, why they're pricing it that way, and then for the broker to educate them to maybe look at it this way. So through this 45-day marketing period, we're tracking all this data. We're seeing how it's comparing to historical assets that are similar to this that we've sold through the years. So we have benchmarks that we can kind of monitor the activity and the traction on. But through all this, we're relaying this data to the owner or the seller. And in that case, it could be a lender, it could be a lender and a borrower getting ahead of a foreclosure, or just a normal private client looking to sell the asset. But through all this, we're relaying that data and giving them this information, this insight, so they're prepared to make a business decision when it comes down to it. The other unique thing about 10X is all the diligence is done on the front end. So when we launched our marketing efforts, that 45-day marketing period is essentially the buyer's diligence period. We'll have everything from the offer memorandum, rent rolls, leases, financials, to third-party reports that we front the cost of, updated title commitment, and then lastly, the purchase and sale agreement. So everything that a buyer would need to typically get comfortable with the asset and the opportunity is readily available for them on the front end. Because when they show up for auction, they are qualified, they're vetted, they understand the terms and conditions and what's expected if they win the auction, which is 10% down, 30-day non-contingent close, some flexibility on the closing time frame as well. And that's one of the things or one of the ways we've evolved as a platform. But nonetheless, they're ready to go, and they're going to put their best foot forward and participate via the auction setting. There is a strike price that there's no obligation to sell it unless you hit that price. But the unique thing is the ownership group has the opportunity to meet the market, lower their price based on all this insight and intel that we've received during that process. And the best part is you've got upside through competition, right? If there's multiple parties that like it at that, call it price or that fair market value, they then have to compete in real time to have the opportunity to win the asset. And so that is how we drive competition and ultimately yield the best and final price through those marketing efforts.
So is a borrower should be ready with their framework to deal with a lender, right? How often do you get a situation where a borrower is like got to chase a bid and not have a lender because it was never real to begin with that he'll win the bid, so the lender doesn't put in all the effort, but then once he's moving ahead, he ends up striking a bad deal with his lender and ends up scrabbling for the cash?
Yeah, so it's a great point. I think I understand what you're saying. Are you speaking to how many times are buyers paying cash versus getting a lender to fund the transaction?
Well, more, I'm wondering how you manage getting a decent loan if you're buying on 10X, or is it just you need to buy cash and
Sure.
that's the value of surety of execution and you're just getting a deal done?
Yeah, so it's twofold. I think if you think back, the last 2 years, that was historically at its lowest levels, and we wanted to try to evolve as a platform to let people utilize debt. And because at the end of the day, it gives them more purchasing power. It can drive pricing upwards. And so it used to be as is where 30-day close, non-contingent. If you can't do it, there's 10 other guys behind you that will. And so one of the ways we evolved is we started looking at extensions to the closing process, right? It's still going to be non-contingent, but we're going to give you more time and maybe in return for some additional hard money. Then through that process, our team, the listing broker, we're going to work with that buyer and really vet them out. And so when buyers, one of the questions we ask when we're vetting these buyers out is, how do you intend on funding the transaction? Is it cash? Do you have a lender? And if they say lender, then we have a whole other round of questions we're going to ask. Have you done a transaction with this lender before? Are you approved at the borrower level, or has that lender actually looked and underwritten the deal? Because there's no contingencies. And so we like to ask what type of rate they're looking to achieve, right? If they say I want a 50% LTV and 2% interest rate, we're really not going to get that much stock into that, right? So we're really trying to vet them out and make sure that the lender is ready to go. I'll ask certain things. I just had one where the lender's like, we need estoppels by the two largest tenants, and estoppels is not something typically required as a closing condition. But he said he needed to stop us for the 2 largest tenants, and then, reliance on the phase 1. Both very simple. The seller was like, no problem, we'll get that. And so from the lender perspective, we checked all those boxes, and that allowed that individual buyer to step up in price. So that's the fun part about our job. Every situation is different. Even when I've sold the same deal multiple times through the years, and both are very different experiences. And so we try to cater to what the market is saying, and then pivot to do so in order to allow the market to really get aggressive, feel confident in what they're bidding on, and get comfortable with it, because it can be a little bit challenging to buy something in a non-contingent auction setting.
Interesting. So Stacy, I think that brings an interesting point to something that I know you've been involved with. I know you've been working with different lenders that are technology driven, right? How far away do you think we are, or is the downturn going to set it back a bit from people to be able to get some blanket pre-auction commitments so that they can really act on distressed property and move quickly, as opposed to having to go to through the normal usual process? I don't think we're gonna get to, hey, DocuSign, boom, done, have a good day, like the EIDL. But the point is, do you think we could get to that point, or is it just still too complicated, and the market's just too complicated for that?
Well, I'm fascinated by what Brad is talking about with regards to just having it all on the front side. I think that's the challenge that a lot of lenders have, is that they get a deal. And what I've seen is the deals that have the information on the front side, boom, we can get through those faster. We've got it there. Then we're just relying on the time to turn for the third parties, because, you have to have that extra third checkbox as a lender a lot of times. What I'm curious to hear from Brad is that I've heard from brokers that, we're seeing volume slow down. Instead of getting 10 bids, they're only getting 5 bids, and maybe they're not hitting it because the cost of debt is now causing, a ruckus with regards to, oh no, I don't want to pay that price. So are you still seeing that to be the same trend in the auction platform? And do you feel like, with regards to the information that you gather up front with your team vetting it, does it make it that much more smooth? Because that's what we have to do for lenders on more traditional brokers.
Sure. Great question. I mean, at the end of the day, we want to try to make this as simple as possible and transparent as possible, right? Our intent is not to trick anybody. If there's, we want to lay everything out on the table. And, on average, I'd say we get about 10 bids or 10 approved buyers per asset. And then in regards to the bids, probably about 10 bids per asset. That has gone down, right? What I've seen in the market recently is, there seems to be a lot of liquidity in the market. Obviously, the lending is kind of tightened up a little bit as well. We don't have 20 guys lined up to buy these assets. There's not 10 guys that it's really coming down to that are competing. It's a little harder to get these deals across the finish line. Maybe it comes down to, 2 or 3 or 2 to 5 buyers that are a little bit more serious, and we may have to be a little bit more creative in order to get the deal done. So at the end of the day, people still need to buy real estate. They still need to sell real estate. It's just a little bit harder to get it across the finish line, and we just got to be a little bit more creative with that. But the other part of that was the third-party reports, all the diligence on the front end. When there's assumptions or unknowns or things that just aren't clear, buyers in the market are going to make assumptions, and all that means is a discount, right? And so we do want to be transparent when we want to try to lay out everything on the table, very transparent. So in regards to third-party reports, phase 1 environmental study, property condition assessment for immediate CapEx, what might be needed for reserves through the years. Then in addition to that, we'll take it a step further. We're going to get rent rolls. We're going to get age receivable reports, right? We want people to understand what they're buying, how the tenants are performing. When we vet these buyers out, I mentioned we kind of go through how they're intending on purchasing the asset, but in short, they've got to provide proof of liquid funds to us. They've got to show an adequate amount of cash, and then they have the ability to bid up to 110% of those funds that they provided. They are capped at that, and the only way for them to continue to bid beyond those means would be to provide additional proof of funds, or simply communicate to the deal team, the broker, the 10X team, how they intend on funding that transaction at the end of the day. But I think that's been the key for us, is laying it all out on the front end, making it as simple, transparent as possible. That way that you're giving confidence to the market that they know what they're buying.
And you've established the market price. I mean, so back to you, Shlomo. He's establishing the market price.
Yeah, and I think just to comment on 10X, what I love about it is that when you hire a local broker, even a national focus on the local buyers, you get a national audience when you're dealing with 10X. And I think it's important as we deal with the stress, a lot of the stress stuff is going to make its way through 10X because lenders want a quick resolution very often. Let's work towards dealing with the stress. So let's say you borrower that has the stress, right? So the first thing I'd say, you need 60 to 90 days before you approach your lender if you want to be out ahead of it. If you want to just play catch up, well, good luck on that. Because even you're 69 days ahead of time before approaching the lender, then you got another 60 days hereafter till the lender gets their act in order. And there are so many pitfalls along the way with regards to funding expenses in the meantime, so that you don't trigger any type of recourse carve-outs. For example, you don't have money for electric because you set up your lockbox and your term sheet because you didn't negotiate well enough where you did it. You couldn't get the term where they get interest before expenses. So you'll never default until you can't have enough money for expenses. And then the lights get turned off, tenants vacate, and all of a sudden you get yourself a recourse litigation against you. So this whole term of recourse versus non-recourse is really the devil's in the details. But here's a key thing that I think a lot of people don't know. Drew, you could talk to this, right? CMBS is complex. If you think your 15 docs in CMBS is like, oh my God, compared to the 2, just had a mortgage and a note back in the day. Now I got a loan agreement, I got assignment leases of rents, I got assignment of agreements, I got all these various things. That's great. But on the back end, there's something called a pooling and servicing agreement that basically dictates how the cash flow gets distributed and how it's sliced and diced. So it's really complex, right? So in order to actually litigate with a lender, which usually you're not going to win, it's just a question of timing. Sometimes there could be some over aggressive approaches and you'll still lose. We could talk about that another time. And I'm always glad to discuss it and people don't realize really what they're up against. There's really nothing to prevent a lender from going aggressively at you once you default. Even if you don't default, they could declare a default and there's nothing to stop them from sometimes putting a receiver in place based on what your lawyer did. But I'm not going to cry with spilled milk. Let's move on. So I guess the question, Drew, is people don't realize that most large firms are conflicted out. Can you talk about the strategy that lenders employ and what you need to be prepared for if you're a distressed borrower?
Well, sure. I mean, it's no secret that the largest banks shop around to a bunch of different firms, and with the idea that we spread a little work out, and if a matter comes in adverse to us, we're conflicted out. And this is a strategy that lenders employ in every big city. Every big bank does it. And so the idea that a lender uses one particular firm, they might go to that firm for specific issues, but you'll see, the big name banks will have matters at every firm. My firm is a little unique in that respect because we're a little smaller. We're about 100 lawyers. Like I said, we do quite a bit of bank work, but we don't have the same level of conflicts. And that's why our firm has been very lucky to collect very good lawyers from other large firms that are seeking to avoid those types of conflicts. What I'll tell you, though, in terms of the strategy behind how sort of lenders operate is, there's always skeletons in the closet, so to speak, on some of these deals, right? So, and to your point, Shlomo, CMBS is a totally different ballgame. My experience has just been with traditional commercial loans, more recently with CMBS loans, but traditional commercial loans are a little different because the lender's calculation is multifold. Right. The first thing that we would do as lenders counsel is we'd review the loan documents and make sure we understood what our rights and remedies were. And in part of that is looking at, are there any things that the lender missed when they originated the loan, which happens. So for instance, if the lender didn't gather certain documents at closing, and now they're seeking 3 years later to get the documents, the lender didn't enforce the financials periodically being given to them. This was happening quite a bit during the Great Recession, where some documents were not properly signed or notarized. And so the lender initially should understand, as lenders counsel, you should understand what the documents say and what they don't say. And I think for CMBS, like you said, Shlomo, it's you're up against not only a 100-pound gorilla, but a 10,000-pound gorilla with the pooling and servicing agreement behind in the trust. So I think what you're really needing to do at the very, very beginning as either a lender's attorney or a borrower's attorney is get a very comprehensive understanding of the documents, what the allegations of default are, if those are what you would consider material defaults, or if the lender is being nitpicky on certain things. And I would say the biggest thing that I've seen during my career that has tanked deals is the breakdown of communication. No lender likes to feel like there's something going on behind the scenes that they don't know about, or no lender obviously likes to be hit with, the 11th hour, we're in really big trouble. So in an ideal scenario, a borrower and their consultants, their people, their attorneys will have some sort of a roadmap to get ahead of these issues. And it's not always easy, it's quite challenging. And we'll talk about this, I think, a little bit later, but it's best if a borrower comes into a situation being realistic and knowing what their skeletons are in the closet.
Yeah, and I think clearing out your skeletons ahead of time is important before the stress happens, because if you have skeletons, you will be perceived as the bad guy, whether or not it's your fault or not. I think there's a couple of things to consider when you're going with a lender. And I think one of the most important things are, and the best asset managers and lenders side do this, and the borrowers at the most success do this, which is check your ego at the door. There's going to be times when you look at each other and saying, you're such a moron. I can't believe, just like, why do you act like that? Why aren't you being realistic? Why? But you don't know what's happening on the other side. And I think, Stacy, to that, and you could talk about, I quote sort of, I tweeted this as a teaser. I'm like, when negotiating with your lender about your distressed loan, it's you trying to salvage your failed business plan versus them trying to salvage their failed business plan. Stacy, could you please talk a little more as someone who's on both sides of the equation, what the challenge is?
I mean, right away, like you said, I do a lot of B piece underwriting too. So the deal is already baked. The investor's looking at when I say baked, I mean, the loan's already been made. We are looking at the business plan. We are looking at it over the next 10 years. But again, all we have to cover is debt. It's not our problem that you didn't do what you needed to do. It's only our problem. And I think we talked about this, guys, before, if it gets to the level where it's going to impact my debt, my performance. I'm sorry that you underwrote 10% return, that you took out cash at the beginning of a deal. You have no skin in the game. That is not my problem. My problem is that I need you to make the deal perform. I lent you this money with the assumption that you're going to pay it back. I'm not your partner in the deal. It's important to me that you find a way to make this right, but it's not my obligation to lend you more money to make your business plan work. I can go take my deal to Brad and have him put it on the market. And I have already worked through, when I lent you that money, a baseline value that I thought it was. So I'm going to have to be hard convinced to believe that I am not going to hit that, especially if I take it over to Brad and have the marketplace look at it. I don't know if that's the answer that you're looking for, Shlomo, but
no, it's exactly what I was looking for, right? So when you're a BP's buyer, which is essentially in a CMBS trust, you're at risk for the first loss, right? When you bought the bond, or any bond holder, you bought a series of cash flows that you guaranteed, not to some crazy person, but to the borrower's own grandmother, who invested in a mutual fund that invested in a fund that invested in a CMBS trust, right? That's how she gets her returns. Okay, so you as a lender promised that. The fact that the borrower now can't deliver it, you need to look at it and say, what's the best opportunity for me to give as close as possible a return to this person I took the money from? So now that the business plan failed, just because your business plan failed, that's great. Has mine failed? And if it has, what's the best resolution? If you're a borrower that hasn't proven themselves to know what you're doing and have made multiple mistakes, and in reviewing the diligence, I just don't have confidence in you, you're not getting a workout. But if you can show me that it's the market, if you can show me that the problem is more than just you, or isn't you, and you've done the best possible, then I know my best recovery business plan is not by getting a whole new people coming in and operating it, but rather having you deal with it. That being said, there are other divergent interests as well, where there's certain decision makers behind the scene that may decide they want to do things different ways. And then there's the overall thing, and forgive the French over here for all the people, there's something called schmuck insurance. I don't want to work it out with you and then 2 weeks later or a year later realize that you cashed out $20 million, right? Meaning I'm not going to do a deal and look like a, forgive me, schmuck. So that's very important for a borrower to realize as well. If you think you're going to fool your lender, it's possible it'll happen. I'd put it at 5%, give or take. And by the way, if you do really fool them, usually when you do a modification, you sign that you haven't withheld information. So you really have got to fool yourself as well, to be very frank with you. So that's important. So if you're out of the money, you need to tell the lender why you should get another shot at resolving this distress. You don't get to sort of just say, hey, have a good day. I think you should give it to us because no lender wants it. Of course, they don't want it, but it doesn't mean you get them the money back sooner. That's sort of how I look at it. It's about maximum recovery. I think there's something here, I think Drew and Stacy, you could talk about as well, which is the types of cash that could be recovered and who benefits from it, specifically in the CMBS side of things. So there are regular monthly payments, principal and interest, right? Let's first talk, Stacy, if you could talk a little bit. A lot of time borrowers say, well, if they only reduce it to interest only, it'll be perfect. And who cares about interest? Who cares about the principal anyways, if you recover it at the end of the day, right? But Stacy, bondholders don't look at it that way, do they?
We've got a cash flow stream and it flows from the top to the bottom. And in some cases, there's an interest only strip where, the interest only goes to a completely separate investor. But at the end of the day, you've got two levels of risk. You got the risk on the bottom when when those rents are not being paid and those debt services not being paid, they're not getting their payment on time. So their return is impacted. And then if you're not exiting, same thing on the top side. Those class A guys, they're looking for the prepayment at the right time when they predicted it. They're not going to get hit with the losses with regards to the cash flow streams of you not paying your debt service, but they are looking at the end of the day to make sure that they've modeled their cash flows out. They've modeled their returns, their exits. They're going to reuse that capital in other places at other times. So again, you're messing with their business plan, and they've got, when we bid on things, there's a thing called the stipulation, the stip, and that has to do with what they're baking into their plan with regards to losses, when they happen, how they happen, how much is happening. So it's still an estimate across a pool of 100 to 200 loans. However, if you don't do what you're supposed to do when you're supposed to do it, you're impacting that overall bucket of what they've estimated, and they're going to work to minimize that.
Yeah, so essentially all the cash goes into this mixer. And the way it goes in and how it's labeled when it goes in, it's really, money is fungible, right? A dollar here, a dollar, it's irrelevant how it's applied to the bondholders. So Drew, so when I'm negotiating with a lender and the lender, or let's take a special servicer, for example, because that's my expertise. That's what I see things more often than not. So when you're dealing with a special servicer and they want default interest from you, or they want a modification fee from you, right? What are they really saying?
Well, what they're saying is, we hold all the cards, right? So we drafted the documents. We know exactly what they say. There's 25 pages in these documents in terms of how do we collect the cash? How do we distribute the cash into your various sub accounts? And at the very end of our cash collection from your tenants, you may see some profits. You may see some waterfall coming your way. But the lender, the big deal with CMBS is payments by tenants into the lockbox, because as the owner, you don't get that front end control of the cash. And so it's critically important to understand that, when your loan is accused of being in default, and I say accused because sometimes it's not truly correct. Lenders do make mistakes. Occasionally, a lender will be overreaching. And I think I say occasionally. Shlomo, you may disagree. You may think lenders are often overreaching. I try to give them the benefit of the doubt, but at the end of the day, this is what happens when you go to court. Judge always falls back on the loan documents, because it's a tenet in the law, obviously, that the court doesn't have the power to recreate a contract. Only if there's some significant ambiguity in the language will the court start interjecting what its opinion is on what the documents say. So it gets us back to where we were at the beginning, which is from your term sheet, what are the covenants and conditions? How is the cash going to be managed by your servicer? And it's really, by the end of the day, as we know, if a loan goes into default, first the payments go to all the lender fees, then they go to default interest, then regular interest, then principal if you're lucky, if there's anything left. And so the lender really does hold all the financial cards. And I just want to echo something that Stacy said earlier, and it's critically important because I've heard this line several times, both in court pleadings and also in workout meetings with borrowers and their attorneys, which is, we came to you, with open arms and an open book on our financials, on our situation. You should be working with us. And the reality is there's a very critical line in every loan document that says no fiduciary relationship exists between us here, which means if things ever get at odds, then we are not friends, we're not joint venturers, we're not partners. We are true third parties in a transaction, and by definition, adversaries. So I think it's whatever side of the equation you're on, whether you're a consultant, attorney, borrower, lender, when the gloves come off, I really do think that the documents are almost always beyond one-sided, and so the borrower has a really big uphill battle by the time they get to a significant default.
Yeah, and I think it's fair to say that you're really not dealing with a friend on the other side, because quite frankly, the second they gave you the money, it's no longer friend, it's business, right? And I know that sounds like a mafia line, but it's not personal, it's business, but the reality is it's not. So you just have to remember that on the other side. And so long as you keep it business and not a friendship or betrayal or that, you'll be constructive about it, I think is what it comes down to. Another thing to consider about default interest and penalties is that they go to the special servicer in a CMBS format. So that's their fee. So when you're negotiating, you say, okay, get rid of that. You're basically telling the other person, the other line, that their cash, their personal cash should be thrown out the window in exchange for the bondholders to get it. So you got to think about the fact that not only do you have divergent interest with the lender at this point because you both have failed business plans, but also they have divergent interest with bondholders, which is a whole different story about the conflicts of interest in CMBS. But as a borrower, that's none of your business. You got the money. You need to pay it back. If you can't, you need to figure it out from there. Brad, I'd love to, if you could just give a little insight into when you deal with a lender selling a note or a distressed property, what are some of the most important things that they want to see? So if I'm a borrower on this, where if I'm a buyer, I'm trying to buy distressed assets, what do I need to focus on? Number one, besides obviously price, but sometimes you may talk about maybe you don't go for the top price. And number two, if I'm a borrower and my thing is up on auction.com and maybe I get the opportunity to bid, how should I deal with that, right? Because in reality, is it helping me price discovery? So these are a couple of things. If you just talk about it, I think will be helpful for the crowd.
Sure. So I think the first thing is every asset that we look at on 10X, 10X, we have a lot of data. We're gonna look at it for what it is. We're gonna look at it in real time. We're gonna compare it to sales comps, data that we have on other similar assets that have sold through the years. Then we're obviously going to rely on the brokers, and they're going to provide a BOV. And then through that whole process with the lender or the seller, the broker, and 10X, we're going to come to a conclusion on where we think this should be priced at. And if that's all in agreement, we can proceed with 10X. And as I mentioned, that reserve price is not shared. What I see from the lender's side, they want to make sure that they're getting the highest and best value and price for their asset. For us, we can't really look at, it's harder for us on our side to say, well, this is the remaining obligation on the debt. We'll certainly take that into account, but at the end of the day, the market value is the market value. The market's going to pay what it's willing to bear. The asset, I would say, is half of what we look at. The other side of what I look at is what is the situation, right? I think with any auction setting, there is some flexibility needed within reason, right? Obviously, if we're looking for, I'll use an example, 10 million for this asset, but everyone else is at 5 million, we may have missed the mark, but that's what's good about 10X. We're going to understand why we missed the mark. Why did it come in so low, and why is there such a discrepancy? And then what could we do specifically to the deal to make this get closer to that ultimate value? Or what could we shift or adjust on our marketing efforts to kind of get that back up? So, when we don't successfully sell assets, we do sell about 70% of the assets that we do take to market. But for the 30% that we don't, it's not a bad experience. We understand why we missed and what we can do to kind of resolve that and get back to a better spot. But the other half of it is the asset. The other situation is the scenario. Like, what is that situation in that scenario? Are you just looking to get one price and you're not going to have any bit of flexibility based on that feedback? Are you going to be open to that market feedback within reason? And those are the clients that I see really benefit from 10X, those that have some flexibility and willingness to meet the market within reason. From the lender side specifically, they're looking for data. We have a very interactive and intuitive dashboard that we work off of. The broker, the 10X team, they're going to be leaving notes. We can see from the bidder side how often they went to the website, when they signed the confidentiality agreement, what documents they look at, what documents did they download, how many times they've been back and forth on the website. So we can kind of test their level of engagement, and we see that progress through that marketing period. So the clients, meaning the sellers, the brokers, the 10X team, they have access to that, and that's what we kind of work off of the entire marketing period to really gain and get that insight. We can leave notes for specific individuals. So, if we have 100 confidentiality agreements signed, we can kind of hone in on, hey, here are the 10 or 15 that are most serious. I think from the buyer side, this is storytelling, right? The broker, I would say, is certainly the most important part of our process. Maybe aesthetically speaking, this is kind of like eBay, but individuals or buyers in the market, they don't just go show up, and buy a $10 million asset like they would an iPhone off eBay, right? And so the broker's job is imperative. It's really important for them to show, to one, build rapport and connect with all of the individual buyers, build some credibility to try to assist them, but tell them the backstory, create that excitement, and ultimately get them to step up and participate at the auction. So that's what I see the buyer side really looking for. They want to see what that situation, what that scenario is. They want to know that they have, a motivating situation, because everyone's looking for, value add kind of distressed opportunities. So we do focus on the situation and the scenario. And I'd say that's probably what's most important on the buyer side.
Interesting. So we're going to put out the CLE code. I believe it's already been put out, but we'll give them momentarily. I want to talk about some of the tricks of the trade. If you're dealing with a lender, there's sometimes you will not get a deal done. But then there are some tricks of the trade that some of them are intuitive, some of them are counterintuitive to deal with. So I'll go with mine first, which is when there's a distressed property, there are two ways a lender could deal with it. They could work it out, or they can foreclose. If you're not in default, they only have one option to work it out. Doesn't mean they will. Doesn't mean you should continue paying forever. But there is a limiting factor. Litigation, fact, guys, please. The lender is not afraid to litigate with you. They'll spend as much money as it takes. That's not a factor. It's their job to deal with any issues, and it's their job to deal with litigation. So I think that's important. Stacy, I don't know if you want to throw something out with regards to how to best deal with the lender, some tricks of the trade that a borrower should bear in mind.
I think it's important to note that asset manager doesn't just have your loan. They've got a stack of anywhere between, 20 to 40, depending on if they're performing, if they're a special servicing asset manager, and they have active cases right and left. So the easier that you make their job, meaning the more that you can summarize things, point them to things in the documents, provide things that are clear with regards to your pro formas, the easier that you make their job, the more likely that they are to not be spending time spinning if they've got an ego trying to prove themselves, just getting to square one with you. So, while they're not your partner, it only behooves you to actually bring clarity to the situation as best you can with, again, summaries, financials, market values.
Yeah, they're not your partner, be in the same boat. So one of the solutions is to throw you overboard, right? So it's
Well,
really-
I can throw my hands up. I can either put my glasses on and look at what you've given me, and hopefully it's succinct and it's going to get there, and then I can have a conversation with you, or I can throw my arms up and say, whatever, I can't deal with you today. I need 2 weeks to get through your documents. See you then.
Got it. Drew, any thoughts with regards to the best way to deal with a lender if you're a borrower encountering some issues?
Well, I think what I've seen over time is the ego really plays into the equation a little too much on the borrower side. If you own a very nice piece of commercial property, whatever your distressed situation is, a lot of borrowers
Hold
will
on,
come.
distress. That's the CLE code. He just said it. Bing, 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 go.
Okay, we all get a bonus for this. I think what happens typically is if the borrower is the one doing all the talking, then most lenders will initially try to hear them out, but borrowers have a tendency to repeat themselves. And what I've seen really with the most success is when borrower has someone else talking for them, whether it's a consultant or a lawyer. When it comes directly from the borrower's mouth, it's perceived maybe a little bit differently. I don't know if there's at some point trust breaks down, and at some point the lender will say, look, we don't want to deal with this person anymore, or this group of people. Maybe they're infighting amongst themselves, the principals don't get along, somebody dies. There's a host of personal issues that come into play with borrowers, and lenders look at it from a balance sheet perspective. And at some point in the deal, what a borrower needs to understand is that lender will say, this loan for us is an exit. It's crossed the Rubicon. It's going to Brad. Okay. And so what a borrower needs to do is put all the pieces in place long before that happens. And I would say having a consultant or a lawyer, out on the forefront, even having, your accountant prepare audited financial statements is a big deal, because a lender doesn't want to chase real financial statements for 3 months trying to figure out what your problems are. So, use third parties when it's appropriate, when you can afford it, would be my advice.
Yeah, I think you hit on the attorneys, and I think one thing that's very important is that, and sometimes attorneys don't realize that when you're in a regular litigation, 2 attorneys talking on the phone could reach a deal. When you're in a CMBS litigation, the attorney does not control the client. It's not like I go to my attorney, he's like, listen, this is the best you're going to get. The judge, or any type of foreclosure litigation, I think to a certain extent, because these are financial considerations, unless it gets personal and you sort of got to take people out of the equation, which isn't easy. You really need to understand that it's not about the attorney. The attorney is here to put in front of the asset manager the best set of solutions, which includes potential foreclosure and going after other remedies, going after people personally. And by the way, if you think values are going to decline like anything and lenders won't go after borrowers, of course they will. They'll get it wherever they can. And it's very easy, to add a person's name to litigation. And by the way, when that happens, you probably won't get another loan or anything else you got going on. It's going to be very difficult. So I would just say it's important to get the advice of attorney every step of the way. Even me, when I do workouts, I'm always in conversation with attorneys. Hey, what do you think of this? What do you think about this? Because even if something worked in New York, it may not work in Florida, right? What's the exposure if we fight, right? There are anti-litigation carve-outs. There are a lot of different things. So Brad, best practices for a purchaser trying to buy on auction on 10X, going to your old name, a 10X. And what's the best way for them to get a deal done other than the obvious, just constantly raising your price? And you didn't address whether you go for top dollar or not every time. So if you just throw that in as well.
Sure. So best advice I'd say as a buyer is, one, bid early and bid often, right? You want to showcase that you're serious. You want to throw your hat in the ring. You've got to bid to give yourself a shot. So I do see a lot of buyers say, hey, I'm interested, but call me if it doesn't sell, right? I can tell you from our perspective and the broker's perspective, we will reach out to you, but you're last on the list. We're going to reach out to all the individuals that did go through the process, that did register, that did throw their hat in the ring to try to make this work at the auction. Because at the end of the day, this is the this is the direction that the ownership group went to try to sell this asset. So it's really no different than a traditional transaction, other than that the terms are a little bit tighter. So these are the terms they're looking for. So I'd say bid early, bid often, and then probably more importantly, I'd say communicate, right? It is always helpful to speak to the broker, right? They're there for a reason. They are very knowledgeable on the asset. They're going to be able to give you a lot of additional insight, along with the 10X team. We want to make sure that you're comfortable with the terms, the conditions, and what to expect. You know, there's not a lot of wiggle room with our process. It's pretty straightforward, as is where is, and you're expected to perform. So I'd say just communicate. You know, at the end of the day, our contracts are non-negotiable, but everything is negotiable, right? All you have to do is ask, and the worst response you'll get is no. But you can always ask for maybe some additional time, or get further clarity on some, maybe some of the items that maybe aren't as clear. But you need to do that on the front end, right? You don't want to go through the whole process, win the auction, and then start negotiating, right? That's going to get yourself in trouble. So communicate. We're here to work with you and get you comfortable, and give you the most confidence in participating at the auction. So communicate, speak with the broker, really do that diligence on the front end, and then, like I said, bid early, bid often.
You got it. So just going to wrap up here. I'll just say thank you to everybody. Just to run through everyone quickly. So Stacy is probably, I don't know, a due diligence person who is, well, I don't want to pigeonhole you, but someone who gets every part of the lending process, diligence, surveillance, CMBS bonds, things like that. I don't know anyone better than you. So if anyone ever encounters a situation, well, if you're doing deals, you need diligence, please reach out to Stacy. In my experience, it's not an easy get, and just having Stacy join us today has been really a treat. So thank you for that. Drew, really, as a lawyer, I've been on the lender side, the borrower side. It's so important, the perspectives you bring to clients, right? Even when I deal with clients in distress, when you're involved, you're able to sort of back up. Like, I'm saying something, but I'm advising them. I'm on their side. They want to hear what the lawyer has to say about something that's totally non-legal. But the fact that you have experience on both sides is really, really great. And Brad, just working with you both as a buyer and as a seller, it's just amazing. And the value you bring, I could tell you, I had deals that fell apart multiple times, put in auction.com, and I exceeded what the LOIs and contracts that fell apart previously, going to 10X. So, I'm always glad to answer any questions anyone has. Could be reached at Shlomo Chop on any of the social media. All my DMs are open. You could email me at schopp@caseps.com. Thank you, Riverside. And just very quickly, so Stacy, you're stackedsolutions.com, correct?
Correct.
Brad, you're 10X. Drew, give us your website one more time.
www.wsh-law.com. Weiserota Helfman.
Got it. And we all monitor our LinkedIn. So thank you, everybody, for joining. Thank you, Riverside. And the CLE code is the word distressed. DISTRESSED. Yes, I won the spelling. We thank you, guys.
Thanks so
Thank
much.
you, everybody.
Thanks so much.
Be well.